Fed's 2025 monetary policy and market impact. Welcome back to Market Snack, where we dissect the forces shaping your financial future. In 2025, the Federal Reserve embarked on an aggressive monetary policy path, leaving a trail of volatility in its wake. Our analysis reveals that these actions erased over $3 trillion in market value in just 6 months. Today, we'll break down the Fed's key decisions, explore their far-reaching consequences, and equip you with an actionable playbook to navigate this complex landscape. Understanding these shifts is crucial for protecting and growing your portfolio. Let's dive in. The Fed's 2025 journey began in January with a 50 basis point rate hike. This initial move signaled a commitment to tackling inflation, but it was just the beginning. The market braced for further tightening. Then, in April, the Fed surprised everyone with a 75 basis point rate hike. This aggressive action sent shockwave through the financial system. By June, the Fed paused rate hikes, providing a brief respite. Just as markets were reeling from that 75 BPS surprise, Washington dropped another bomb. In April 2025, the administration hiked tariffs on $300 billion of imports, some duties now as high as 145%. That reignited inflation fears, pushed input costs up for manufacturers, and forced yields even higher as traders priced in a prolonged Fed hold. However, the pause didn't signal a complete policy reversal. Quantitative tightening, or QT, continued unabated, draining liquidity from the market. This combination of factors created a challenging environment for investors. The unexpected 75 basis point rate hike in April was a pivotal moment. It was largely driven by persistent inflation and stubborn wage pressures. The Fed felt compelled to act decisively. The immediate market reaction was swift and brutal. Stocks experienced a 2.5% intraday drop, reflecting the market's surprise and concern. Investors scrambled to reassess their positions. This aggressive move underscored the Fed's unwavering commitment to price stability. It also highlighted the potential for further volatility in the months ahead. The market was officially on high alert. Beyond rate hikes, quantitative tightenings played a significant role in shaping market dynamics. The Fed ramped up QT from $60 billion to $95 billion per month. This accelerated the removal of liquidity from the financial system. As QT intensified, banks started hoarding cash, fearing future funding shortages. This reduced the availability of credit for businesses and consumers. Hedge funds were forced to deleverage, selling assets to reduce their exposure. The combined effect of these actions was a spike in volatility across asset classes. From stocks to bonds to commodities, uncertainty reigned supreme. Investors struggled to find safe havens. Let's examine how these policies impacted specific companies. Apple, for example, saw its margins decline due to higher borrowing costs. This put pressure on their profitability. Higher tariffs on Chinese components added to their margin squeeze. Tesla's growth faltered as increased financing costs made it more expensive to expand production. Also, tariffs on imported parts pushed their production costs even higher. Not all companies suffered, however. Biotech XYZ jumped 30% on positive trial results, demonstrating that innovation can still thrive even in a tight monetary environment. This highlights the importance of sector-specific analysis. The Fed's actions had far-reaching consequences across various asset classes. Bond yields spiked as investors demanded higher returns to compensate for increased risk. The 10-year Treasury reached its highest levels in decades. Crypto markets were hit particularly hard by margin liquidations. Bitcoin experienced a significant drop as leverage positions were unwound. Gold, on the other hand, rallied as a safe haven asset. Oil prices peaked due to supply concerns exacerbated by geopolitical tensions. This added further inflationary pressure to the global economy. The interconnectedness of these markets became increasingly apparent. So how can you navigate this challenging environment? First, consider locking in yields with short-dated treasuries. Think 1 to 3 year notes at 4.5% plus for a relatively safe, stable return. Next, hedge your equity exposure. Buying deep OTM puts on SPY or going long a low-cost VIX ETF can blunt sudden sell-offs. Finally, rotate into defensive sectors. Utilities, staples, and dividend aristocrats tend to hold up when growth stocks stumble. Mix these three tactics to build a balanced, resilient portfolio. The other way to protect your investments would be to hedge your equity risk with volatility plays or protective puts. This can help mitigate potential losses in a market downturn. Finally, rotate into defensive sectors that tend to perform well during economic uncertainty. Staying informed is crucial in this environment. Closely monitor the Consumer Price Index or CPI for signs of inflation. Pay attention to speeches by Fed Chair Powell for clues about future policy moves. Eye those incoming tariff announcements. Any tweaks will reverberate through CPI, corporate earnings, and could even shift Fed expectations again. Track updates on quantitative tightening to gauge the pace of liquidity withdrawal. Set price alerts for potential market downturns to react quickly to changing conditions. Knowledge is your best defense. By staying vigilant and informed, you can make more informed decisions and protect your portfolio. Remember, navigating a complex market requires a proactive and disciplined approach. Don't let fear or uncertainty drive your decisions. The Fed's 2025 monetary policy and the parallel tariff shock has undoubtedly reshaped the financial landscape. Understanding how aggressive rate hikes, quantitative tightening, and sweeping import duties interact is essential for navigating the challenges and opportunities that lie ahead. We hope this analysis has provided valuable insights into both Fed moves and trade policy risks. If you found this video helpful, please subscribe to our channel for more in-depth analysis and actionable strategies. We're committed to providing you with the information you need to succeed in today's complex market. Now, we want to hear from you. What's your market outlook for the rest of 2025? Share your thoughts in the comments below. Let's start a conversation and learn from each other. Thank you for watching.